The great debate: lump sum versus dollar cost averaging. In the world of investing, few topics spark as much discussion as the choice between lump sum investing and dollar cost averaging. Both strategies offer distinct advantages and disadvantages, leading to ongoing debate about which approach reigns supreme. Lump sum investing involves investing a large sum of money all at once. Dollar cost averaging, however, spreads out your investment over time with regular contributions. This essay delves into the complexities of both strategies, examining their historical performance, psychological implications, and practical considerations to help you make informed investment decisions. Diving in, understanding the two approaches. When it comes to investing, there are two primary strategies that investors often consider: lump sum investing and dollar cost averaging. Each approach has its own set of advantages and potential drawbacks, and understanding these can help you make more informed decisions about your financial future. Lump sum investing is like taking a deep dive into the market. Imagine standing at the edge of a pool and deciding to jump in all at once. This method involves committing your entire investment capital up front, aiming to capitalize on potential market growth from the get-go. You commit your entire investment capital up front, aiming to capitalize on potential market growth. This approach can be particularly effective if you believe the market is poised for an upward trend. However, it also comes with the risk of market volatility, as your entire investment is exposed to market fluctuations from day one. This approach aligns with the adage "time in the market beats timing the market." By investing a lump sum early, you give your money the maximum amount of time to grow, potentially benefiting from compound interest and long-term market gains. By investing early, you give your money more opportunity to grow. The longer your money is invested, the more time it has to benefit from the market's historical upward trajectory, despite short-term fluctuations. On the other hand, dollar cost averaging is a more measured approach, similar to dipping your toes into a pool gradually. Instead of investing all your money at once, you spread your investments over a period of time. You invest fixed amounts at regular intervals, regardless of market fluctuations. This strategy can help mitigate the risk of investing a large sum during a market peak, as it averages out the purchase price of your investments over time. This strategy aims to mitigate risk by averaging out the purchase price of your investments over time. By doing so, you can potentially reduce the impact of market volatility and avoid the stress of trying to time the market perfectly. Both approaches have their merits, and the best choice depends on your individual financial situation, risk tolerance, and investment goals. A look at the numbers historical performance comparison. Historically, lump sum investing has tended to outperform dollar cost averaging in periods of rising markets. When the market trends upward, investing a large sum upfront allows investors to capture greater returns. However, this approach comes with higher potential downsides if the market declines immediately after the investment. Dollar cost averaging, while potentially lagging in bull markets, provides a cushion during market downturns. By investing consistently, DCA investors purchase more shares when prices are low and fewer when prices are high, potentially leading to a lower average cost per share. The human element, psychology's role in investing. Investing isn't just about numbers, it's also deeply personal and influenced by psychological factors. Loss aversion, the tendency to feel the pain of a loss more strongly than the pleasure of an equivalent gain, plays a significant role in investment decisions. Lump sum investing can trigger anxiety for those fearing a market downturn immediately after investment. Dollar cost averaging, with its gradual approach, can alleviate this anxiety by spreading risk over time. Regret, the feeling of remorse after making a decision, also influences investors. Numerous studies have analyzed the effectiveness of lump sum investing versus dollar cost averaging. A Vanguard study found that lump sum investing outperformed DCA about 2/3 of the time in the U.S. market over the past several decades. However, the study also acknowledged that DCA could be beneficial in volatile markets or when investors have a shorter time horizon. Ultimately, the optimal strategy depends on individual circumstances, risk tolerance, and market conditions. Section 6. Navigating risk and time. Crucial considerations. Market timing, the elusive art of predicting market movements, significantly impacts the success of both strategies. Lump sum investing relies on favorable market timing, while dollar-cost averaging aims to negate its importance. Transaction costs, though generally low, can accumulate with dollar-cost averaging's frequent investments. Individual risk tolerance plays a crucial role in determining the best fit. Investors comfortable with potential short-term volatility might favor lump sum investing. Those seeking a more measured approach with lower potential for regret often prefer dollar-cost averaging. Section 7. Finding your fit, tailoring your strategy. The choice between lump sum and dollar-cost averaging isn't one-size-fits-all. If you have a significant sum of money available and a long-time horizon, lump sum investing aligns with the principle of maximizing time in the market. This approach might be suitable for younger investors with a higher risk appetite. Conversely, if you're investing a smaller amount regularly, such as through a 401k or IRA, dollar-cost averaging can be an effective strategy. This approach is often favored by those closer to retirement or those who prioritize minimizing potential regret. Section 8. Case Studies, Real-World Examples of DCA and Lump Sum. Consider Sarah, a young professional who receives a $20,000 inheritance. Sarah is in her early 30s, has a stable job, and no immediate financial obligations. She decides to invest this windfall rather than spending it. With a long-time horizon and a healthy risk appetite, she opts for lump sum investing in a diversified portfolio of low-cost index funds. Sarah believes that by investing the entire amount at once, she can take full advantage of the market's long-term growth potential. Over the next 2 decades, her investment experiences significant growth, outpacing the returns she might have achieved with dollar-cost averaging. By staying invested through market ups and downs, Sarah benefits from the power of compounding and the overall upward trend of the stock market. Now, let's look at John, who is nearing retirement and receives a $100,000 retirement payout. John is in his late 50s and is more risk-averse due to his shorter investment horizon and the need to preserve his capital for retirement. Concerned about market volatility so close to retirement, he chooses dollar-cost averaging, investing $10,000 per month over 10 months. This approach allows John to spread his investment over time, reducing the impact of market fluctuations and lowering the risk of investing a large sum just before a market downturn. This strategy allows him to weather a minor market correction during that period, ultimately achieving his desired retirement income goal. By investing gradually, John can take advantage of lower prices during market dips, which helps to smooth out the purchase price of his investments and provides peace of mind as he approaches retirement. Section 9. The bottom line, choosing the best path for you. The decision between lump sum investing and dollar-cost averaging hinges on your financial circumstances, risk tolerance, and market outlook. Each method has its own set of advantages and potential drawbacks, making it crucial to understand them thoroughly before making a choice. Lump sum investing, historically favorable in bull markets, offers the potential for higher returns, but comes with greater short-term volatility. This approach involves investing a large amount of money at once, which can be rewarding if the market is on an upward trend. However, it also means that your investment is more exposed to market fluctuations, which can be nerve-wracking for some investors. Dollar-cost averaging provides a sense of control and potentially lower average purchase prices, but might lag in rapidly rising markets. By spreading out your investments over time, you can mitigate the risk of investing a large sum during a market peak. This method can be particularly appealing to those who prefer a more measured approach to investing, as it reduces the impact of market volatility on your portfolio. Ultimately, the best approach is the one that aligns with your individual needs and allows you to invest confidently and consistently over time. Consider your financial goals, investment horizon, and comfort with risk when deciding between these strategies. Remember, there is no one-size-fits-all answer in investing. Consult with a financial advisor to determine the most suitable strategy for your unique situation. A professional can help you weigh the pros and cons of each method, taking into account your personal financial landscape and long-term objectives. This tailored advice can be invaluable in helping you make an informed decision that supports your financial well-being.